All right, today we're going to pull back the curtain on a key financial metric that lenders absolutely live by. It's called the debt service coverage ratio, or DSCR, and it's basically a lender's secret weapon for figuring out one very, very important thing.
And that one thing is this. How does a bank, or an investor, or really anyone lending money truly know if a business has the financial muscle to actually pay back a loan? Okay, let's dive into this.
You'd think it's all about how much profit a company is making, right? I mean, that makes sense. But honestly, that's not the whole story. Lenders have to look deeper. What they really need to know is about the actual spendable cash a company has on hand to cover its debts, month after month.
And that brings us to the star of the show, the debt service coverage ratio. Put simply, it's a direct measurement of a company's available cash flow versus what it owes in the near future. It's kind of like the ultimate stress test for a company's ability to handle its debt load.
Now, the formula might look a little intimidating, but I promise it's actually pretty straightforward. All you do is take the company's net operating income and divide it by its total debt service. So let's break down what those two parts really mean.
First up, you've got net operating income. Just think of this as the money a business makes from its main gig, its core operations. It's the revenue you bring in, minus the day-to-day costs of running the place. And here's the really key part. This calculation leaves out taxes and interest payments. That's totally on purpose. It's so you get a clean, unfiltered look at just how profitable the core of the business actually is. And on the other side of that equation, you have the total debt service. This is pretty much everything the company has to pay on its debts over the next year. We're talking principal, interest, lease payments, the whole shebang. This is the financial weight that the company is carrying on its shoulders.
Okay, so you've plugged in the numbers. You've divided your net operating income by your total debt service, and you've got a number. So what? What does that number actually tell a lender about the health of your business? Well, this is where it gets really important.
Let's say your DSCR comes out to 0.95. For a lender, that's a huge flashing red flag.
So why is that so bad? Well, it means your business is only bringing in enough cash to cover 95% of its debt payments. You're coming up short. And to make up that 5% difference, you might have to take on even more debt. And you can see how that becomes a pretty dangerous cycle fast.
All right, what about a perfect 1.0? That means you're breaking even. You can pay your bills, but just barely. There is absolutely zero room for error, no cushion whatsoever, which is why lenders still see this as living on the financial edge.
And that's exactly why lenders are always looking for a safety cushion. For a lot of them, the bare minimum they want to see is a DSCR of 1.25. That extra 25% is the buffer they need to feel comfortable. Just in case things don't go exactly to plan.
But if you really want to make a lender happy, you show them a number like 2.0 or even higher. That means you've got enough income to cover your debt payments twice over. It just screams financial strength and tells them you're a very low-risk borrower.
Now, you might have also heard of a similar metric called the interest coverage ratio. So what's the difference? It's a simple one, but it's a really big deal. The interest coverage ratio only looks at whether a company can pay the interest on its debt. The DSCR, on the other hand, is much more comprehensive because it includes both the interest and the principal payments. It just gives you a way more robust, way more complete picture of a company's actual financial fitness.
So, theory is great and all, but let's make this real. Seeing how the DSCR works in an actual scenario, well, that's when you really see how powerful it is. Okay, so picture this. A real estate developer is looking for a mortgage. Their rental properties are generating a net operating income of just over $2.1 million a year. And their total annual debt payments, that total debt service, is going to be about $350,000. So you do the math, right? You divide that income by the debt service, and boom, you get a DSCR of 6.14. That is an incredibly strong number. It means the developer has enough income coming in to cover their debt payments more than 6 times over. To a bank, this looks like a very, very safe bet.
But the DSCR isn't just for getting a loan in the first place. It can be a really critical term inside a loan agreement, and the consequences for letting that number slip can be severe, as one airline actually found out. So in a loan agreement with the U.S. Treasury, Sun Country Airlines had a special clause, a covenant, tied directly to their DSCR. The quote here shows that if their ratio dropped below that critical 1.0 break-even point, something would trigger, and the lenders would have the right to take 50% of certain revenues. That is a massive penalty, and it just shows you how seriously this metric is taken in the real world.
So, the DSCR is obviously a powerful tool, but like any single financial metric, it's not perfect. It's really important to understand both its good sides and its limitations.
On the plus side, it's awesome for tracking financial trends, and it's way more comprehensive than other ratios, but it does have some weaknesses. For instance, it relies on something called accrual accounting, which tracks revenue when it's earned, not necessarily when the cash is actually in the bank. And since there's no single universal standard for a good DSCR, it can sometimes be like comparing apples to oranges if you're looking at different industries.
But let's bring it all home. Despite its nuances, the DSCR is still one of the most vital tools in finance. For lenders, for investors, and even for business owners themselves, it gives you a clear, pretty standard way to check on a company's basic ability to pay its bills.
It gives us a really powerful snapshot of financial health, for sure. But it also leaves us with a bigger question, doesn't it? Can a single number, no matter how good it is, ever truly tell a company's whole story? It's something to think about next time you see a headline that hangs on just one little metric.